All right, welcome back to the deep dive. Ever look at a company's financial report and just wonder, how trustworthy is this really?
It's a fair question.
Yeah. So today, we're kind of pulling back the curtain on the folks who help answer that, the auditors. We're going deep into how they actually find, evaluate, and deal with mistakes, or the official term, misstatements, in those financial
It's a
statements.
fascinating process, really.
Totally. Our mission today, let's break down this whole audit thing. We want you to walk away really getting what goes on behind the numbers, why it matters, and maybe uncover, what makes a tiny error suddenly become significant.
Yeah, the idea of materiality is key.
Exactly. So, okay, let's start right at the beginning. An auditor gets the financial statements. What are they actually looking at? What are they scrutinizing to form their conclusions? What's the game plan?
Okay, so it's definitely not just a quick skim. Think of them as like financial detectives. First, they're looking at the results of their overall analytical procedures.
Analytical procedures.
Yeah.
What does that involve?
That means they're scanning the financial data, looking for unusual trends, weird relationships, things that just don't quite add up compared to expectations or industry norms.
Okay, so spotting anomalies.
Exactly. And then they meticulously review every single misstatement they found during the audit. That includes any mistakes management might know about, but decided, well, not to correct.
How interesting. Even the uncorrected ones.
Especially those.
Yeah.
And crucially, they look at the qualitative side of things. How does the company actually do its accounting? It's not just the numbers. It's the judgment calls, the policies, the consistency.
Gotcha. The how, not just the what.
Precisely. Plus, they're actively looking for any red flags, any conditions pointing towards, fraud risk.
Yeah.
They examine the whole presentation, the statements themselves, all the footnotes, the disclosures. Is it clear? Is it complete?
I
And sort of underpitching all of this, they have to make sure they've gathered enough good, solid audit evidence to support their opinion. The ultimate goal. To be able to say with reasonable assurance that these financial statements are free of material misstatement, whether that's from an honest error or, unfortunately, sometimes fraud.
Okay, that really clarifies the scope. So they find something, it looks a bit off. How do they make the call? Is this just a tiny typo, a little hiccup, or is it actually a serious problem that could mislead someone reading the report? Because, like you said, not every penny difference matters. Right.
Exactly right. Auditors aren't expected to find every single tiny error. They gather up or accumulate all the misstatements they do identify, except for ones they decide are clearly trivial.
Clearly trivial. Okay, that sounds important. What's the distinction? How is that different from just not material?
Ah, good question. They're definitely not the same. Clearly trivial is a much, much lower bar. It means something is truly, absolutely inconsequential,
Like pocket change.
pretty much.
Yeah.
It has to be insignificant on its own, and even when you lump it together with all the other trivial things they found, and it doesn't matter how you judge it by size, by its nature, the circumstances, it just has to be completely unimportant. The key word is clearly. If there's any doubt, any uncertainty at all, then it's not trivial.
Okay, so they might set a really low dollar amount, maybe. Anything below, say, $50 is trivial. But that threshold has to be super conservative.
Extremely conservative. It has to be set low enough that even if there are other errors lurking around that they haven't found, anything below that trivial threshold would still never be material, individually or added together. It really shows you the caution involved.
Wow, okay. So beyond trivial, they get into evaluating materiality. How does that work?
Yeah, materiality is central.
Yeah.
Quantitatively, they often start by comparing the size of the misstatement to key financial bases. Things like net income, maybe gross sales, total assets, total liabilities. Is the error 1% of profit? 0.5% of assets. That gives them a starting point, a sense of scale.
But it's not just a simple percentage calculation, is it? Like, you can't just say 5% of net income is always material.
Absolutely not. That's just the start. They have to look at the effects both individually. How does this error affect this specific account or disclosure? And also in aggregate, what's the combined impact of all the non-trivial errors on the financial statements as a whole? It's a bigger picture view.
A holistic perspective.
Exactly. And here's where it gets really interesting and maybe a bit complex. If the total of all the misstatements they've found starts getting close to that overall materiality level they set,
Uh-oh.
yeah, they have to seriously consider the risk that there might be undetected misstatements out there, stuff they haven't found yet. Could those, added to what they already know, push the total over the materiality threshold?
Wow, okay, so they're estimating the unknown too.
In a way, yes. They factor in that risk. Plus, they have to think about errors from last year or prior periods that might still be affecting this year's numbers. So you can see, determining materiality, it really comes down to professional judgment. There's no magic formula. It's a critical judgment call.
That makes sense. And it explains how something that looks small number-wise could actually be a big deal. You mentioned qualitative factors earlier. Can you give us some examples? Like, when does a small dollar error become material because of its nature?
Oh, definitely. This happens all the time. A misstatement, even if it's quantitatively small, can suddenly become material if, for example, it affects profitability trends. Or worse, if it masks a change in a trend.
Like turning a small loss into a tiny profit.
Exactly. Or making things look stable when they're actually declining. That's huge.
Well,
Or maybe it affects whether the company is complying with its loan agreements, debt covenants or other contracts or regulations.
failing a covenant because of a small accounting error could have massive consequences.
Huge. Or think about this. What if the error increases management's bonus or compensation? That immediately raises eyebrows about potential bias. Or if it involves fraud or illegal acts, even a tiny amount is material then.
Right. Intent matters.
Absolutely. Other things auditors consider. Does it affect key parts of the financial statements that users focus on, like recurring earnings? Is the error objectively clear-cut, or is it tied up in subjective estimates? Does it mess up segment information? Does it misclassify something important, like moving an expense from operating to not operating?
So many angles.
It is. They also think about, what do the users of these statements actually need to know? Does this error matter to them? Sometimes you might have several errors that partly offset each other, but they're individually significant in different ways. Or an error might be small now, but likely to become material in the future. Or maybe it's just really costly or difficult to correct. All these qualitative factors weigh in.
You mentioned management bias. That sounds tricky. What if the auditor gets a feeling management isn't being entirely objective?
Yeah, that's a critical assessment. Management bias can be subtle. Maybe management is very quick to correct errors that make the company look bad, but slow to fix ones that make it look good.
Selective correction.
Or perhaps management conveniently finds offsetting adjustments right after the auditor points out an error. Or maybe there's just a consistent pattern of optimism in their accounting estimates or choices.
So what does the auditor do then?
They have to step back and evaluate. Does this potential bias, when combined with all the other uncorrected misstatements, actually result in the financial statements being materially misstated? It's about looking at the pattern, the potential motivation, not just isolated incidents.
Okay, so finding and evaluating is step one. Step two must be talking to management, right?
Absolutely essential. Auditors have to communicate all the accumulated misstatements, except the clearly trivial ones, remember, to the appropriate level of management. And they need to do it promptly. And crucially, they have to ask management to correct them. It's not just informational. It's a request for action.
And what happens then? Does management usually just fix everything?
Often, yes. If management agrees and corrects the misstatements, the auditor then has to do more work, perform additional procedures, just to make sure the corrections were done properly and no new misstatements were introduced.
Due diligence.
Exactly. Sometimes, especially if the error involves judgment, like a fair value estimate, the auditor might ask management to go back and re-examine their own assumptions and methods. For straightforward factual errors or problems from prior years, they'll directly request specific adjustments.
What if management pushes back? What if they say, no, we're not correcting that?
That definitely happens. And when it does, the auditor needs to really understand why. What are management's reasons for refusing? Is it a disagreement about the amount, about whether it's truly an error, about its materiality?
And that reason matters.
It matters a lot, because the auditor has to consider management's reasoning when forming their final overall opinion on the financial statements. And even if an uncorrected misstatement isn't material this year, the auditor needs to communicate that it still exists and could potentially affect future financial statements. It gets documented.
Let's make this really concrete. We have that ABC company summary of possible misstatements example. Can you walk us through that?
Sure. So imagine the auditors found three key things for ABC Company. First, $80,000 in liabilities that weren't recorded. That makes liabilities too low and income too high.
Okay.
Second, they found the allowance for doubtful accounts, basically. The estimate of unpaid invoices was overstated by $45,000. That means assets were too low and expenses were too high, so income was too low.
Right, offsetting the first one partly.
Exactly. And third, there was an inventory counting error, overstating inventory by $60,000. That makes assets too high and cost of goods sold too low, meaning income is too high.
So a mix of effects. How does it shake out?
Well, if you just add the absolute amounts, it's $185,000.
Hmm.
But the net effect is what's critical for the overall picture. Let's see. Assets are actually overstated by $15,000. The 60K inventory overstatement minus the 45K allowance overstatement.
Mm.
Liabilities are understated by $80,000, and income before tax is overstated by $95,000. The 80K unrecorded liability impact plus the $60 inventory impact minus the 45K allowance impact.
Wow. Okay, so the net income impact is $95,000 overstatement. That's the number they'd compare to their materiality threshold.
That's the aggregate income effect, yes. They compare that and the effects on assets and liabilities to their materiality levels. It shows how different errors can interact. And this brings up a really key point, a pass key, as some materials call it.
Okay.
Management is ultimately responsible for the financial statements. They get the final say on booking any adjustments the auditor proposes. If management refuses to correct some errors, and the auditor concludes that the remaining uncorrected errors are not material, individually or in aggregate,
Then what?
then the auditor documents the uncorrected errors, documents their conclusion that they aren't material, and explains why.
Mhm.
And they can still issue a clean, unmodified audit opinion.
As long as the remaining errors don't cross that materiality line.
Precisely.
Okay, that's a critical distinction.
Yeah.
Now, all this work, all this judgment, there must be a significant paper trail, right? What exactly does the auditor have to document?
Oh, the documentation is crucial. It's the evidence of the audit. They must document that amount they set below which misstatements are considered clearly trivial.
Got it. The trivial threshold.
Yep. Then they need a record of all misstatements accumulated during the audit, basically, everything that wasn't trivial, and very clearly note whether each one was corrected or not.
Okay.
And then, maybe most importantly, for any misstatements that management didn't correct, the auditor has to document their conclusion about whether these uncorrected misstatements, individually or added together, are material. And they have to explain the basis for that conclusion. Why do they think it is or isn't material?
What goes into that explanation?
That documentation needs to show the aggregate effect of the uncorrected misstatements on the financial statements overall. It needs to state whether any specific materiality levels they set for particular accounts or disclosures were exceeded. And it should also evaluate the effect on key ratios, trends, and compliance with things like loan covenants. It's a comprehensive record of that final judgment call.
So, switching gears slightly, when an auditor finds these misstatements, especially the material ones, what does that tell them about the company's own internal controls? Is finding a mistake automatically a sign that the controls aren't working?
Not necessarily automatically, but it's often a very strong signal. Think about it. If the auditor finds a material misstatement that the company's own systems, its internal controls, failed to prevent or detect and correct in the first place.
Yeah, that sounds like a problem.
It is. That situation is generally considered an indicator of what's called a material weakness in internal control over financial reporting.
And a material weakness means?
It means there's a reasonable possibility that a material misstatement of the financial statements will not be prevented or detected and corrected on a timely basis by the company's controls.
Okay, so finding a material misstatement suggests a material weakness might exist.
It's a strong indicator, yes. But interestingly, the reverse isn't always true. Just because a company has a material weakness doesn't automatically guarantee that its financial statements are materially misstated right now. It just means the risk is significantly higher.
Oh, okay. Risk versus actual misstatement.
Exactly. So the auditor has to carefully evaluate the type of misstatements found and their cause. Was it a simple error? A complex estimate gone wrong? Fraud? How often did this kind of thing happen? Does it affect other parts of the audit? What are the overall implications for the financials? This helps them decide if the findings are consistent with how they initially assessed the company's control risk.
And this could change the whole audit plan, couldn't it? If they find more errors than expected or signs of weaker controls.
Absolutely. It has a ripple effect. If the auditor finds inconsistencies or more errors than anticipated, they might have to reassess their whole audit risk model. That could mean changing the nature, timing, or extent of their audit procedures. Maybe they need to test more transactions, increase their sample sizes, or do different kinds of tests altogether. It's a dynamic process. Even small dollar misstatements, if they point to control issues, can significantly impact the audit.
Okay, that makes a lot of sense. So we've identified errors, evaluated them, talked to management. Let's assume some need correcting. how does that physically happen in the books? It's not just crossing numbers out, I assume.
Definitely not. It's a formal accounting process using what are called adjusting journal entries, or AJEs for short.
AJEs.
These are the official entries made in the company's accounting system to correct the errors and make sure the financial statements reflect the right numbers. They can affect pretty much any account: assets, liabilities, equity, revenue, expenses.
So how do they work? How do you know whether to debit or credit?
It goes back to basic accounting rules. You need to know the natural balance of an account. Assets and expenses normally have a debit balance. To increase them, you debit. To decrease them, you credit. Yeah. Liabilities, stockholder equity, and revenues or sales normally have a credit balance. To increase them, you credit. To decrease them, you debit.
Got it.
So if something is overstated, you do the opposite of its natural balance to bring it down. If it's understated, you do the same as its natural balance to bring it up. Exactly. Let's use that example from earlier. Sales made on account were overstated. Sales revenue normally has a credit balance. Accounts receivable, an asset, normally has a debit balance. Since both are overstated, we need to decrease them.
Right, so decrease sales, decrease accounts receivable.
Correct. To decrease sales, a credit balance account, you debit it.
Yeah.
To decrease accounts receivable, a debit balance account, you credit it. So the AJE is debit sales, credit accounts receivable. That fixes the overstatement.
Perfect. That clears it up. Now, inventory seems like a place where things can get tricky, especially with goods in transit. You mentioned FOB terms earlier. Can we unpack FOB shipping point and FOB destination? They sound technical, but seem really important for ownership.
They are crucial. FOB stands for free on board, and these terms define the exact moment ownership and therefore risk transfers from the seller to the buyer. This determines who should have the inventory on their books at year end.
Okay, so let's take the buyer's perspective first.
Right. If your client is the buyer, and the terms are FOB shipping point, they take ownership the moment the goods leave the seller's location, basically, as soon as it's on the truck or ship. So
Yeah.
even if it's still in transit at year end, the buyer should include it in their inventory.
Even if they haven't received it yet.
Correct, because they own it.
Yeah.
But if the terms are FOB destination, the buyer doesn't take ownership until the goods actually arrive at their facility, the destination. So if it's in transit at year end under FOB destination terms, the seller still owns it, and the buyer should not include it in their inventory yet.
Okay, that makes sense. And flips if the client is the seller.
Exactly. If your client is the seller, under FOB shipping point, they give up ownership and remove the item from their inventory as soon as it ships. Under FOB destination, they keep ownership and keep it in their inventory until it reaches the buyer's location. It's all about pinpointing that transfer of title.
Got it. And how does the type of inventory system a company uses affect adjustments, like perpetual versus periodic?
Good question. The system affects how inventory is normally tracked, which can influence how an error is discovered or corrected. In a perpetual system, inventory and cost of goods sold are updated continuously with every purchase and sale. There are usually 2 entries for each sale. One for the revenue, debit cash AR, credit sales, and one for the cost, debit cost of goods sold, credit inventory.
Okay, real-time tracking.
Pretty much. In a periodic system, they don't track cost of goods sold with each sale. They just record the revenue, debit cash AR, credit sales. Then, at the end of the period, they do a physical count of inventory. They use a formula. Beginning inventory plus purchases ending inventory at cost of goods sold. They make one big entry at period end to record COGS and adjust inventory.
So errors might be caught differently, but the goal of the AJE is the same, get the final numbers right?
Precisely. Let's use that inventory example again. ABC Company, periodic system. They missed $20,000 of inventory at a distribution center in their year-end count.
Right. So their ending inventory number was too low by $20,000.
Correct. And in that periodic formula, if ending inventory is understated by $20,000, then the calculated cost of goods sold, COGS, will be overstated by $20,000.
Ah, because they subtracted too small an ending inventory number.
Exactly. So the correcting AJE needs to do 2 things. Increase inventory and decrease cost of goods sold. Inventory is an asset, natural debit. So to increase it, we debit inventory for $20,000. Cost of goods sold is an expense, natural debit. So to decrease it, we credit cost of goods sold for $20,000. So debit inventory, $20K. Credit COGS, $20K. Fixes both problems.
Crystal clear. One last tricky inventory area. Consignment. What's the rule there? Who owns what?
Consignment can seem confusing, but the rule is simple based on ownership. If your client is the consignee, meaning they are holding goods owned by someone else, the consignor, to sell on their behalf, Those goods are not the client's inventory. Exclude them.
Makes sense, they're just holding them.
Right. But if your client is the consignor, meaning they've sent their goods to be held and sold by someone else, the consignee, those goods are still the client's inventory until the consignee sells them. So include them, even though they're physically somewhere else. It always comes back to who holds title.
Wow, what a comprehensive journey through the world of misstatements. We've really covered a lot, from how auditors first evaluate the financials to that crucial judgment call on materiality.
The communication back and forth with management, which is so critical.
And even down to the nuts and bolts of making those adjusting journal entries to actually fix the books.
And throughout it all, I think the main takeaway is that financial statements are meant to give users, like you listening, a true and fair picture. Auditors are that independent check, ensuring the integrity of that picture. Understanding how they handle errors and judgment calls is really key to, well, trusting the numbers you rely on.
Absolutely. So, thinking about all this, the judgment, the communication, the potential for bias, the materiality thresholds, what does this deep dive mean for you listening?
Yeah, maybe think about it next time you see an audit report.
Right. When you see that auditor's opinion, what does it really tell you now about the story behind the numbers? And how might knowing about this process, the detective work, the debates, the corrections, change how you look at financial news or make investment decisions in the future? Something to think about.